Imagine this. Your car breaks down tomorrow. The repair bill is $1,200. Or you get an unexpected medical bill. Or your landlord raises your rent and you need to move at short notice. For most Americans, any one of these situations would mean going into debt, pulling out a credit card, taking a personal loan, or borrowing from someone they know. Studies consistently show that a significant portion of adults in the U.S. couldn't cover an unexpected $400 expense without borrowing. $400. That's the gap between financial stability and a spiral into debt for millions of people. The solution to that problem has a name, and it's called an emergency fund. In this video, we're going to break down exactly what an emergency fund is, how much you actually need in one, and most importantly, where to keep it so it works as hard as possible for you. This is Yield Report Daily. Let's get into it. Everything in this video is purely educational. We're here to explain concepts and explore options, not to tell you what to do with your money. Every financial situation is different, so always consider your own circumstances and consult a licensed financial advisor before making any financial decisions. So what exactly is an emergency fund? In simple terms, it's a dedicated pool of money set aside specifically for unexpected expenses or income disruption. Not for holidays, not for a new phone, not for anything planned, purely for genuine financial emergencies. The purpose is straightforward. It acts as a financial buffer between you and debt. When something goes wrong, and at some point something always does, you reach into your emergency fund instead of reaching for a credit card or a loan. This matters enormously because debt is expensive. A $1,200 car repair on a credit card at 20% interest, paid off over a year, costs you considerably more than $1,200. An emergency fund means you pay exactly the cost of the emergency, nothing more. It also provides something that doesn't show up on any spreadsheet: peace of mind. Knowing you have a financial cushion fundamentally changes how you experience day-to-day life. The most common question people have about emergency funds is, how much is enough? The general guidance discussed across the personal finance community is 3 to 6 months of living expenses. So the first step is understanding what your monthly expenses actually are. This means rent or mortgage, utilities, food, transport, insurance, subscriptions, everything you need to keep your life running for 1 month. Once you have that number, multiply it by 3 for a starter emergency fund and by 6 for a more comprehensive one. For example, if your monthly expenses are $3,000, a 3-month emergency fund would be $9,000 and a 6-month fund would be $18,000. Those numbers can feel overwhelming if you're starting from scratch, and that's completely normal. The key thing most financial educators emphasize is that you don't need to hit the full amount before it starts working for you. Even $500 in an emergency fund covers the most common unexpected expenses most people face. Start somewhere and build from there. Before we talk about where to keep an emergency fund, it's worth quickly covering where most people keep theirs, and why that's not ideal. Most people keep their emergency fund in the same checking account they use for everyday spending. The problem with this is twofold. First, it's too easy to spend. When the money is sitting right there alongside your regular money, the temptation to dip into it for non-emergencies is significant. Second, it earns almost nothing. The average traditional bank checking account in the U.S. pays around 0.01% interest annually. On $10,000, that's $1 per year. Your emergency fund should be accessible, but not so accessible that you spend it, and it should be working for you while it sits there waiting. That means a dedicated separate account. The option that comes up most consistently in personal finance discussions for emergency fund storage is a high-yield savings account. A high-yield savings account works exactly like a regular savings account. Your money is safe, FDIC insured up to $250,000, and accessible when you need it. The key difference is the interest rate. While traditional banks pay around 0.01%, many online high-yield savings accounts have been paying significantly higher rates, in some periods 4 to 5% annually. On a $10,000 emergency fund, that's the difference between earning $1 a year and earning $400 to $500 a year, just for having your money in the right place. The reason online banks can offer higher rates is straightforward. They don't have the overhead costs of physical branches, so they pass more of the benefit to account holders. Two accounts that come up frequently in this space are SoFi and Chime. Both are online, both are FDIC insured, and both are widely discussed in the beginner personal finance community. Links to explore both are in the description below. Knowing you need an emergency fund and actually building one are two different things. Here's how most personal finance educators suggest approaching it. Step 1. Open a dedicated high-yield savings account separate from your everyday spending account. The separation is psychological as much as practical. Step 2. Decide on a fixed amount to transfer every payday. Even if it's $20 or $50, automation is the key. Set up an automatic transfer on payday so the money moves before you have a chance to spend it. The phrase commonly used in personal finance circles is, pay yourself first. Your emergency fund contribution comes out before discretionary spending, not after. Step 3. Set a visible goal. Whether it's $1,000 as a starter fund or 3 months of expenses as a full fund, having a specific target makes the process feel tangible and achievable. Step 4. Don't touch it unless it's a genuine emergency. This sounds obvious, but defining in advance what counts as an emergency, job loss, medical emergency, essential car or home repair, helps resist the temptation to rate it for non-emergencies. A few questions come up constantly when people discuss emergency funds. Should I invest my emergency fund? The general consensus in the personal finance community is no. Emergency funds are generally kept in stable, liquid, easily accessible accounts rather than investments. The stock market can drop significantly right when you need the money most. Should I pay off debt before building an emergency fund? This is widely debated. Many financial educators suggest having at least a small starter emergency fund, often around $1,000, even while paying down debt, because without any buffer, a single unexpected expense sends you straight back into more debt. What if I use my emergency fund? Replenish it as quickly as your budget allows. Using it for a genuine emergency is exactly what it's there for. The goal is simply to rebuild it so you're protected again. An emergency fund is genuinely one of the most impactful financial foundations anyone can build. Not because it makes you rich, but because it keeps you from going backwards when life happens. Links to explore the high-yield savings accounts mentioned in this video are in the description below. As always, these are affiliate links, meaning if you open an account through them, we may earn a small commission at no cost to you. That's how we keep Yield Report Daily running. If this was helpful, subscribe. We publish new videos every week covering personal finance topics in plain English. No jargon, no financial advice, just education. See you in the next one.